Hey everybody, this is Matt Graham with the MBS Live Market Update. Last week was not so great for the bond market, but in the bigger picture, it didn't do too much damage. It was shortened by the holiday, the New Year holiday, and it was not without significant economic data and events. The first event that came along was JOLTS, Job Openings and Labor Turnover Survey. That has been an increasingly important report for the bond market, and last week's example was no exception. It contributed to gains on the 3rd, and that occurred at 10 a.m. in the morning. Then the Fed was out with the minutes from the most recent meeting 3 weeks ago. The minutes came out on January 3rd. The meeting was 3 weeks ago, and they didn't do any damage. They didn't really push back against the market's takeaway regarding potential rate cuts in 2024, and that facilitated gains to the best levels of the week, with 10-year yields as low as 3.90-ish on Wednesday afternoon. From there was weakness heading into Friday's jobs report. European economic data didn't help, and the Thursday morning economic data didn't hurt too terribly much, but it also definitely didn't help, with jobless claims coming in all the way down at 202 versus a 216 forecast. And we also had ADP jobs beating the consensus by about 50 grand. And even though ADP is not a great indicator for NFP, if it's far enough from forecast, it can still garner a reaction. No major reactions Thursday morning. Markets were really waiting for Friday's jobs report. The jobs report itself was mixed. The headline was stronger than expected. Revisions were negative. The unemployment rate was a little bit misleading because although it stayed low at 3.7 and missed the forecast rising to 3.8, the labor force participation rate went down 0.3%, which is sort of another way to say if the labor force had stayed the same, then the unemployment rate would have risen by 0.3%. So if it had stayed the same, the unemployment rate would be 4%. Those are a lot of ifs, of course, and there can be positive reasons for people leaving the labor force, but it was just one of the ways that the market can sometimes frame a particular result in the economic data to sort of push back on the headline's implication. So in this case, the headline implication was negative for bonds, and these additional layers of complexity helped to push back in the other direction even before the 10 a.m. data came out, and that was the ISM non-manufacturing index. That's the more important of the two ISM reports. The other one is the manufacturing index, go figure. And non-manufacturing came out weaker than expected, nearly in contractionary territory at 50.6. Anything under 50 is considered contractionary. But it was the employment index falling well below the lowest levels of the past few years, all the way back to the lockdown timeframe in 2020 that did the heavy lifting for bond buyers and sparked a fairly big rally on Friday. That got yields from 4.05 all the way down to 3.95. And then sellers came in by the afternoon, and we were right back at pre-NFP levels. NFP referring to non-farm payrolls, the key component of the jobs report. So all told, there was no net reaction to jobs and no net reaction to ISM, but just a lot of high volume volatility in between. Now at the start of the new week, bonds are gaining ground, not for any particular reason. Some people are observing that oil prices continue to operate near their December lows and that they've pushed down a little bit at the start of the new week. It's really hard to make a case for strong correlation over very short time horizons between oil and bonds, so that's not an explanation I want to lean on too much, but we can keep it in mind in the bigger picture as oil prices will eventually filter through to inflation, which will generally filter through to bond yields. In the remainder of the week, there is really only one key report that I would be focusing on, and that is CPI on Thursday. The Consumer Price Index is expected to come in at 0.3 at the core level month over month, and that's the same as last month. Headline is seen ticking up just 1/10 of a point, not paying much attention to the headline, mainly looking for that core reading to be at 0.3 or lower, and that should help bonds continue to hold their ground. In terms of the trend, that is the question. Are bonds going to continue to hold their ground at or below 4 to 4.1% in terms of 10-year yields. I think CPI will go a long way in helping make that determination. That's going to do it for this week. Back to you.
Thanks, Matt. Appreciate it very much. All right, let's get into some discussion on the markets and also the NBA. Alice, I'd like to start off with you. If you can get any thoughts on the NBA report. Glad to see that going on. That was good.
It segues into the report I was also going to give, and that the NBA reported on the 203K proposed changes, which were sitting in a drafting table form on HUD's website. So essentially, they had the mortgagee letter drafted, and we were commenting on that aspect. So it was a unique way of HUD putting their policy that they're proposing on the table. That policy, that ML said that there was still a difference in how high HUD is going to go for a high cost area versus all the other areas. So the mortgagee letter still states in a 203K limited, which we used to know as streamlined, they will go up to 50,000. And MBA is reporting that they know from HUD that's going to be 75,000, which is what HUD approved for the high cost areas. So it'll be, I did put a call out to MBA to find out, hey, how do you know this already? Are you willing to tell us for sure? Or because what's sitting on the mortgagee letter drafting table still is 50,000, not 75. So we will follow up on that with everybody, but also you can watch for that. So that's my comment on that. Don't everybody run out for the 203K at the 75,000 for other areas yet, because it may be that they settle in at 50.
Yeah. So we'll get that. And you get the rest of your report in just a minute. Mr. Kittle, thoughts on we've heard about the markets. Love your thoughts on the market. What's going on within TMC? Anticipation of lower rates following with many with Doug Duncan and Les Parker and others? Or is that what everyone's doing? Or just saying we're going to take it one day at a time, whatever comes?
So we're hearing from our members that business is up, volume's up a little bit, all good news. It's amazing that the rates of today are the rates that where we were maybe 60, 65, 70 days ago. And 70 days ago, they were horrible. So now that they've come back down to those levels, they're great. So again, it's the perception, and you just got to go out and sell in this market regardless of what the rate is. To Adam's report just for a second, it's the administration comes in, I think their last 4 or 5 job reports, they come in with great jobs created, but the last 4 or 5 in a row after they come in have all been revised down.
Significantly downwards. Yeah, I know.
And then the numbers really aren't accurate. So that's a trend and something that needs to be considered and watched.
It hurts the credibility of the initial report, especially when it constantly gets revised downward. And it's okay, we're in an election year. We're going to, is this the spin zone, the O'Reilly spin zone kind of thing going on here with this administration, the Biden spin zone? But we shall see. We know we're going to see a lot of positive spin put on things in a election year, and it is only going to get more so as we head further into the year. Mark Helm, thoughts on what we've heard Les Parker talk about and Matt Graham talk about and the NBA?
I think as I look at it today as a consumer out there and seeing that our Congress is finally working together to get some things done, maybe covering our debt a little while, and also talking to my buddies in the real estate business and in the mortgage business, things seem to be picking up. I see a turning trend that we're seeing here, and I'm seeing a little bit more stability. Matt talked about that. We still go back, and the bonds will trade a little faster, a little slower, and you never know what that's going to end up all term. But I like where we've been recently, and I'm just very optimistic for this year because of the election and things getting better. And I think we're going to be at a much better place in the July, August timeframe than we've been for nearly the last 2 years. And I hope I'm right.
So what's really interesting is I look at a number of economists and how they're forecasting out there. And first of all, when it comes to where the overall economy is going to go, I immediately look to their sponsors or whoever I'm listening to. If it's a gold and silver sponsor sponsoring their podcast, I expect gloom and doom. That's how you sell gold and silver. If it's not a crisis, you spin it out like it's going to be a crisis. So you want to run out and buy gold and silver. So I automatically discount those. There's there's 2 of them actually we're going to put in the show notes for this. One of them was one that is I don't have, I close out all my windows, so I don't have it, so I don't have the notes of it. But he said there's 4 key economic indicators, and one of which he did say, and I wish I could quote the individual, but check our show notes on there. He said is there's GDP, which we all hear about GDP all the time, but in correlation, direct relation to that is GDI, gross domestic income. And 90% of the time, vast majority of the time, those two are working in tandem. They're locked at the hip, just lockstep with each other. When they have departed and GDP has gone up and GDI, gross domestic income, has gone down, without fail, it has signaled a recession, and the degree of the separation is the degree in which the recession will be. There is concern that this could be a much more severe recession this year because of this. And again, this is one of those economic reports. I don't run around. I'm like the glass half full personally. I'm one of those guys. I'm in there with everyone on this podcast. We get a lot of reason where our podcast is getting the ratings it does, the listenership it does, because we try to find the glass half full aspects of it. How do we survive in these markets? What are we doing with it? That's what we're focusing in on. But there are things that you need to pay attention to. And so I destroy and get rid of all the gold and silver dealers inspired forecasts, get rid of those. And I look at those that have really had a track record of doing this. Another guy in a Fox business is Harry S. Dent. It's one of the economists. He's always seemed to be more in the gloom and doom. Now, he made it big when he wrote in the 80s, The Great Boom Ahead. And he studies demographics. When you look at the trends of the population, the baby boomers, what they were doing back in the 80s, now it's the Gen Zers and the millennials. What are they doing now? What is the trend? He is saying we are going to have one of the worst recessions, and it's going to get into a full-blown depression is what he is saying. I don't buy that. I'm not saying that, but I think we need to listen to it, look at it, especially when he has been accurate a number of times in the past. Unfortunately, the last few times his economic forecasts have been not done. And it's something that you talk about, Kittle, a lot, and that is the Fed's policies manipulating what might have otherwise been an accurate forecast. And so I think what it is, we're going to put both of those forecasts in the notes, show notes. So when you go to our Lykken on Lending website, you can click on and watch and listen to both of those economic reports. But I just find that really interesting that both seems like a general trend discounting the gold and silver dealers, which I expect them always to be in the negative. There seems to be more of a trend of a more reoccurrence of we're heading into recession, and therefore the downturn, it's the extent of which we might see. I think whatever it is, I think we just need to be doing what you're talking about, David, and that is being nimble and being on our feet. Throw that out there, get some last thoughts before we get over to Alice on her report. Round the horn on that. David, any thoughts you want to reflect on any of that?
Yeah, I will just comment quickly on what you said. I think whatever you believe, you can find somebody out there to say it.
Yes. I think that's so
And at the end of the day, you still got to do loans and business. What if we go into a recession? Everybody going to walk away? No, you're going to have to buckle down harder and work, or find an alternative environment to work in. So you can get caught up in the minutia of prediction and worrying about where things are going to go and where they are, or you can listen to it and realize that you have to go out and work hard every day and maybe work a little bit harder other days.
Yeah, good, spot on. And Mark, when you look at servicing retention, one of the things I had on with a call several clients recently in the last week, and then again today, earlier before I did the podcast, we're talking about servicing retention, and they're noticing a significant amount of refinancing of their portfolio, even loans that were done in the 3%. And they're going, we thought that was absolutely secure. So when you look at servicing values, Mark, and where the servicing trends are, mortgage lenders, by and large, the better we are at origination, the worse we are at retaining our MSR portfolios, our mortgage servicing portfolios. Love to get your thoughts on that as you look at the market and interest rates ahead, Mark.
I could do a 3-podcast series on that. I've lived it over the years. Let me share a couple critical elements. First of all, lenders have never, ever done a good job on portfolio protection. Right now, in a low market, what they should be doing should be working with their borrowers to let them know their loans are assumable if they are FHA and VA and assumable, so these borrowers can take advantage of that and sell in their properties, and they get to retain the servicing. And they're doing a crummy job on that. And I'm doing a lot of help with some lenders on that program, and that's a big deal. The second thing that's out there right now that's really interesting about the MSR value is that a lot of people are selling their MSR. There's a little bit of a fire sale going on because there's not a lot of people, even though it's a good interest rate and it should have good lifetime, there's not a lot of people buying the smaller portfolios right now. They're looking at the bigger portfolios. So it's hard to sell. So you're not getting a premier price like you should have in the past. But a lot of folks are doing that to survive because they need that equity they got built up in their portfolio to help them on their balance sheet. So a lot of folks are doing that. So I've got a thing I put together. I'll do a sales pitch here for a minute. I've got a 10-point program that I can spin with servicers and tell them all the things I'm 99% sure they haven't been doing that they should be doing to improve their portfolio. Everything from going out and making sure all the people on their portfolio that are paying taxes have all the exemptions they can get to reduce their tax bill, and also working on insurance. There's a couple of new insurance companies that have come up out there that are being very competitive and offering a much better programs than some of the big guys out there. Some of the big guys have backed out of some major states like Southern California and Florida and the Gulf Coast region of the United States because of earthquakes or hurricanes or whatever the case might be. But this company's got a solution for that. So there's a lot of people out there trying to bring the solutions to bear. And the more they bring to bear and the more the servicers pay attention, they're going to benefit from it. But they got to pay attention. And unfortunately, most of them aren't. And it frustrates me having spent all the years I have in the industry.
Mark Helm and I are putting our heads together. We're going to be recording a series of podcasts. To Mark's point, he could do 3 podcasts on that question alone. And we're going to be doing some recording and in the new year here. And I'm really looking forward to those interviews, Mark, because you are just a wealth of information on servicing and how people can retain their servicing and do so more effectively. And looking forward to that very much. Thanks for your thoughts on all of this.
Thank you, sir.
You bet.